Hi, good morning. This is Guangzhi. Welcome to today's webinar. Today is 6 March 2017. So today we will talk about our company initiation coverage on Geo Energy Resources, as well as some company results update on Cogent Holdings, UOL, Hock Lian Seng, Hock Lian, Centurion, and Q&M Dental. Our title is more optics to take off. So optics is sort of sales and purchase agreement that the buyer will make the prepayment to the seller to secure certain amount of sales in the upcoming years, and the prepayment will be funded to the seller's operations. We initiated a buy rating with the target price of 45 cents. The company announced their annual results last week. They declared 1 SG cent dividend for FY16, and its last close price was 27 cents. And its 52-week stock price ranged from 9 cents to 30.5 cents. Its current market cap was around $327 million. As you can see the chart here, its stock price started to rally since the second quarter last year. The reason was due to the underlying asset coal. Its stock price started to recover after it went through 5 years bearish market. Here is the company snapshot. Geo Energy Resources was established in 2008 and was listed 4 years later. So before 2016, the group was mainly engaged in coal trading, mining, and haulage services, as well as coal production business. So last year, it simplified its business model, and it divested the service segment. And right now, it is focusing more on the coal production itself. So currently, the company disclosed its total reserve of coal, which arrived at more than 100 million tons. So Geo, its business model was that it subcontracted the mining work to Buma, which is the second largest mining services company in Indonesia. That means Geo, it doesn't own its mining fleet. Also, it signs the offtake agreements with ECTP, the global merchant of commodity products. So Geo, it doesn't do any direct sales to the end users, but via the commodity trading agent. As far as the geographic sales breakdown, 70% to 80% of the output will be shipped to China, while the rest will remain in the domestic market in Indonesia. As of December last year, Geo had already secured 7 million tons of coal sales with ECTP in FY17. Here are our investment thesis. We will discuss about the global energy consumption pattern, and we will explore further on the coal, its supply and demand. And as we know that China right now is the largest coal consumer, so we will analyze the China's coal market and its outlook. Finally, we will talk about the Indonesia's current coal market development and moving forward, and the future moving forward. And we think that in the upcoming future, the Indonesia domestic market will have a strong growth in coal. Here is the global energy consumption pattern. Now let's take a look at the chart in the first quadrant. As we can see that the fossil fuels including oil, natural gas and coal took up 86% of the total energy consumption in 2015. So back to 15 years ago, in 1985, the proportion of the fossil fuels was around 89%. So in 15 years, the proportion only dropped by 3 percentage points. So we can see, we can derive a conclusion that the transformation of energy consumption patterns is a long-term process with slow progress. And the chart here below shows the world energy demand breakdown of each type, including the fossil fuels, nuclear energy, hydroelectric, and renewable energies. So the total consumption of these energy grew from 7.2 thousand million ton oil equivalent in 1985 to 13,000 MTOE in 2015. So during this period, in 15 years time, the growth rate was 83%. Though the renewable energy had the highest CAGR during this period, in absolute amount, fossil fuels still dominate are still the predominant type of the energy consumption. So the traditional energy will remain the main source of the total energy consumption. The next is the worldwide coal supply and demand. You can see the chart here. So before 2000, the coal's production and consumption were quite flattish. However, by entering into the 21st century, both experience phenomenal growth. You can see here the coal's production growth was around 56% from 2000 to 2010, while the coal's consumption grew by around 53%. So one of the reasons behind this euphoric growth was because China it joined the WTO World Trade Organization in 2001. After that, it established the status of a world factory in such that the manufacturing industries encountered the boom for more than a decade. So which drove up the coal demand and supply. So no doubt you can see the chart below. It showed that the coal migration was shifted from Western countries to the Eastern countries, especially in Asia Pacific. And this was in line with the China's coal boom in the last 15 years. So moving forward, we see that Southeast Asia region will have a strong growth in coal demand, in coal's demand. Here is the China energy consumption. So as of December 2015, China's primary energy consumption took up around 23% of the total global energy. Here is the breakdown of the energy types. So here we can see that China's total energy consumption grew from 1.5 billion tons standard coal equivalent in 2000 to 4.3 billion tons SCE, almost triple up in 15 years time. And coal was still the major source of energy. As of December 15, the coal consumption arrived at 2.8 billion tons of SCE, roughly around 64% of the aggregated domestic energy consumption. So here is the donut chart. We make the comparison in each energy type between 2000 and 2015. So you can see here the proportion of coal consumption dropped by 5% in 15 years, average at 0.3% per annum. This is China's domestic coal supply and demand. So before both reached peak in 2013, it has been both have been trending up since 2000, and the coast production CAGR was around 8.5%, and while the coast consumption CAGR was around 9.1%. However, the central government started to curb the coast production in the past 5 years' time. The reason behind it was the increasing deterioration of environmental quality, especially the haze issues. All these have hampered the economic growth in China, while at the same time, China actually increased the coal import overseas. As you can see the chart below here, from 2000 to 2016, China switched from the net coal exporter to net coal importer. Because the coal imported overseas, their quality is better than the domestic coal, and also the shipping cost is much lower than the transportation cost by rail in the domestic market. So we can have a conclusion that coal is hardly substituted in China, and moving forward in the long term, coal will still remains one of the major energy source. Here are the guidance policies in China, including 13th Five-Year Plan for coal industry, the guidance for Energy Work 2017, as well as the guidance for development of the cooperation between coal and power industries. So all these policies aim to reach the target that to curb to solve the overcapacity and the excessive stock of coal issues. So the latest update was that yesterday, the report on the work of government announced in the National People Congress and the Chinese Political Consultative Conference showed that last year in FY16, the central government has successfully achieved the curb on coal capacity by 290 million tons, which was 40 million tons above the original target. So in this year, the central government will continue to curb on the supply side, and the target is 170 million tons of coal. The next is the Indonesia gold market. So you can see the chart here. Basically, Indonesia is one of the major coal producers and exporters, and for the amount of coal exported to other countries, dominate the output of dominate the output in the domestic market. So for the domestic demand, the Indonesian Energy Outlook 2016 gave the outlook that based on the business as usual scenario, the coal demand will grow by average 4.8% per annum from the base of 17 million ton oil equivalent in 2015. So for the alternative 1 and 2 scenario, the respective growth in coal demand will be 1.2% per annum and 2.2% per year. Here are the investment merits. So we will analyze the GO's competitive advantage in the operations, since it has strong competence in low cash costs and it already secured more offtakes last year, which can propel the sales in this year. And meanwhile, it caught the tailwind amid the business expansion because last year it was a year that the coal price rallied a bit. And in the foreseeable future, we see the catalyst that Geo will do more M&As on the coal mines, as well as more offtake agreements. Now let's recap the business model here. So Geo Energy outsourced the mining work to the third party, so it doesn't own any mining fleet. Also, it deals with the commodity trading agent to secure the offtake sales. So it expands its business skill through duplicating this business model. So this light asset model effectively supports the GO's operations in order to lower its operating costs. Right now, all the major mines that Geo own were open pits with average 3:1 stripping ratio. And as far as the location of the current mines, basically are the 3 mines we show here. The BEK, STJ, and TBR are close to the sea coast. So it means that Geo Energy is able to lower the transportation costs so right now, as we mentioned just now, the total reserve that Geo owned was reached more than 100 million tons. So if you use the current market cap around $327 million divided by the total reserves, we can get the ratio to be around $3 per ton. So according to the management's guidance, the average cost they acquire all these mines were about $4 per ton. That means Geo Energy right now is still undervalued. So as we mentioned, Geo had already secured 7 million tons sales in FY17. However, the management aims to do the sales target of 10 million tons this year. So how do we view Geo? We need to, of course, it catch the tailwind of the coal price rally at the same time of the business expansion. So as far as the catalyst, we need to focus the bullet points here, because right now the total reserve are around 100 million tons. So if we base on 10 million tons per annum sales speed, the total reserve will be depleted in 10 years time, which means that the Geo will they need to do more M&As on coal mines to replenish their reserve. So it is reasonable we expect that this year it will have another acquisitions on coal mine as well as the offtake sales by this year end. Here is the valuation assumption. Basically, we projected the average selling price ASP to be $37 per ton and $37.5 per ton in this year. And the sales volume will reach 8.5 million tons this year and more than 10 million tons next year. Here is the valuation methodology. So we simply use the average 3Q FY16 annualized PE ratio of the comparable peers, which is around 11 times. So what does it mean by the comparable peers? We exclude those market cap which is significantly larger than Geo Energy. So we just make the comparable peers market cap close to Geo's market cap. So according to the annual results, last year in FY16, the EPS was reported at 1.84 US cents. If we times the 11 times PER, we can derive the target price of around 28 SG cents in FY16, which is quite close or match with the current stock price. So we do think that the Geo's current stock price is fair value, but it didn't price into the growth in FY17. So based on our projection and forecast of FY17's EPS of 3 US cents, we derive the target price to be 35 US cents, which is equivalent to 45 SG cents. Here are the investment rates. So as Geo Energy is a mining company, so the underlying asset, which is the coal, matters for the operation and as well as the business. So if the coal price shoot up this year, of course it will have the outperformance compared with our forecast. And the other driver is the capacity. If the company can deliver more than we expect, of course the top line will grow more. So vice versa. So on contrary, if the whole price have a supply shock this year, of course the profit margin will be shrunk. Now let's recap. So we initiated a buy rating with the target price of 45 cents. The next part will be the company results update.
Hi, good morning, everyone. Okay, for the second part, we'll go through the company results for stocks that announced their results last week. Before we carry on, I'm going to send out the survey link for you all to participate in our survey. I've just sent it out. You should see it in the chat box. So please help us to complete the survey. Okay, now we move on to Cogent Holdings. So another record year of higher profit. We are still maintaining our buy recommendation on the stock. Target price 108, slightly lower than our previous target price of 111. We forecast dividend for FY17 at 2.22 cents. Last close was 79.5 cents on Friday. So I'll quickly run through the results. For revenue, you can see it's 5% up. This was mainly a better contribution from 3 out of 4 of their business segments. So the 3 business segments that contributed positively was the container depot management, automotive logistics management, and warehousing and property management segment. The only one segment that contributed less revenue was the transportation management. This was mainly due to a decrease in trucking jobs performed, notably for customers in the oil and gas sector. You can see that at the EBIT level, there was margin expansion to 30.1% from 25.9% year on year. This was mainly due to operating expenses remaining closely similar between the 2 years. This was attributable to the 11% decrease in their fixed costs for rentals and lease premises. This offset the increase in their variable costs. So that's how the operating expenses remain roughly the same for both years, and that led to the margin expansion. So profit before tax in line with the above factors. So profit before tax increased 25% year on year, and that flowed down to the net profit, 26% increase year on year for net profit after tax. Net margin improved to 23.5% from 19.7% last year. So nothing much has. The main thing is that it's still a long-term play for their warehouse facility that they're going to begin construction on Jurong Island. That is no change. However, the 2 changes that we're going to talk about is firstly the negative surprise from the absence of the final dividend. So they have actually been paying dividend fairly regularly, just that this year they decided not to declare any dividend, and the cash is being retained to fund their construction costs for the Jurong Island Chemical Logistics Facility project. So as a reminder, this facility is going to be roughly the same size as the existing warehouse on the mainland. And to give you a sense of scale, I've said this every time, the size of this warehouse is roughly the size in terms of GFA is approximately the same size as Vivo City. So we view the explanation for retaining the cash as fair, and we view that the reinvestment for long-term value creation, reinvestment of the cash will create long-term value creation for all shareholders. The other change is that is with regard to our view on operating costs. This came about because they have been awarded 2 new container depot sites. So previously we said that they will return one of the sites, the Jalan Terusan site on the mainland Singapore, and we were expecting for lower rental expenses in FY17 after we returned that land. But then now they have taken on 2 new sites, a 5.9 hectare plot in Tuas South and a 2.5 hectare plot on Jurong Island itself. So for Jurong Island, they're calling it the Jurong Island Container Depot Project. There's a JICD. So with these 2 new plots, it's going to it has changed our view on their rental expenses. Now we're estimating that they're going to incur an additional 3.0 to 3.5 million rental expense per annum. Overall, in the big scheme of things, we are still positive because of the big project that they're going to do on Jurong Island, the chemical logistics facility project, and that should start to accrue to their bottom line in FY19. So we still maintain buy, target price 108.
Morning everyone, this is Peter here. Just an update on UOL. UOL reported their results last week. So what happens was that in the financial year of 2016, revenue was up 13%. It came up to 1.4 billion, and this was mainly because of higher contributions from property development. So on the gross profit level, unfortunately, there was lower gross margin in property development segment because of the headwinds in the property development market. So in 2016, gross profit was down 4% to $485 million. And on a profit before taxes level, there was higher fair value losses in groups and associates investment properties. And these 2 investment properties were mainly from Faber House and Novena Square. So more updates on that later. Anyway, just a summary on the 3 segments. So for hotel operations, there's a visible pipeline of new hotels, and 5 of them will be added by 2019 to the portfolio. Again, there'll be more to it, so just bear with me on this. Investment properties wise, there will be near-term challenges in the shopping mall of 1 km and Faber House. So these 2 properties, the space expiring represent 10% of the total portfolio's net lettable area. And over in the overseas segment, they've acquired a site in this site's name called Bishopgate in London, which is approved for 43-story mixed development, which can potentially use 160 residential and 237 hotel rooms, and you can expect it to be operational in 2019 and 2020. So there's not much details being reviewed on these yet. We will provide updates as they are more available. So at the same time, they've also did a 50-50 JV with UIC, and they acquired Holborn Island in London, which will add 32,431 net lettable area. So this will not be this is held at the JV level, will not be consolidated to his current portfolio. But if you look at his current portfolio of net lettable area, it represents around close to around just an indication is that it essentially represents around 20,000 of the existing space that they are currently renting out. So finally, at the property development level, so at this point of time, Singapore development projects, 4 out of 5 of them are at least 85% sold. And again, this is all attributable to their nimble strategy. So they, at each and every time, it's about launching developments that are in the niche areas, which they think that which is able to garner sufficient or good traction. So in a way, it's about staying focused on the strategy. So because of that, we saw good performance from a property development segment. And next, we can expect 3 more new developments to be introduced or launched between this year and next year, and is potentially able to add a gross development value of $1.6 billion. So this $1.6 billion is equivalent to around 25 cents to our RNAV. Oh, sorry. We have not included any contributions for from these 3 new developments. But what I'm trying to say here over here is that when completely sold, it will potentially add to 25 cents to our RNAV estimates. Okay, so now well, we talk about the 3 segments here. So this is just a breakdown of revenue and then the operating profits of the group. On a revenue basis, I mean, out of these 5 segments, notice that property development is 51%. But then again, on the operating level, property development is merely only 18% of the of profits contribution. So what is the thing you take over here to take away from here is that 18% of it is from property development. The remaining 82% of it actually comes from recurring income. So this recurring income base is comprised of property investments, which is rental income of their existing office and retail units, and the rest of it, which is hotel operations, investments, as well as management services, which we will not go into details for that. But the thing to really take away over here is that at the end of the day, it's still largely, most of its profits are still largely from a recurring income basis. So for hotel operations, they are launching 2 Pan-Pacific hotels, one in Myanmar and one in Beijing this year in 2017. And these 2 hotels will add 556 rooms, or 5.7% to the group's portfolio of the existing portfolio of 9,804 hotel rooms. So we've actually revised our revenue for in order to take account of the of these two of hotels that will be potentially added into our portfolio. So but then now on these 2 hotels, occupancy rates in for the Beijing hotel is expected to be good, and this is stemmed from the recovering demand for corporate travel in Beijing. But however, on the Myanmar hotel, it's more likely to contribute positively in the longer term, and this is mainly because of the shorter term headwinds that is currently in the Myanmar high-end segment. So Pan Pac Hotel in Myanmar is will belong to the high-end segment, and because of the short-term oversupply of rooms there, it's unlikely to get a good performance there. But on a longer-term basis, is likely to contribute positively because of the well location that it has. It's in downtown Yangon, so there's not much space to be for further developments there, especially when it comes to hotel. Now, we will look further into property development. So if everyone just pay attention to the chart above here, at this point of time, what is really to take away over here is that in the Singapore property development scene, on the property development frontier, for UOL, there's only one development that is significantly left unsold, and that is Principal Gardens. So, but what is to note over here is that Principal Gardens was launched in 2015, and it's already 50% sold. So what is important to take away here is that at the end of the day, Principal Gardens, the units in Principal Gardens are largely larger size in general. So again, I reiterate, in November when my colleague Teh Hong and I, when we talked about when we gave an update on the property sector, what we've noticed is that it's the developments that have smaller units that are actually selling right now. So those which have that are yielding larger units, because of the higher quantum, higher purchase price that they are. So it's harder for home buyers to actually access financing from banks because of the 60% total debt servicing ratio property cooling measure that was introduced in 2013 of October. So for Principal Gardens, they have moved 50%, like I just said, and they are sitting in a very comfortable zone now because QC only comes in 2019, mid-2019. What this means is that they have at least around 36 months or so to clear the remaining units. And looking at which, just in January and February, they moved another 25 units. So the thing the thing take note of is that for 36 months and for the number of remaining units that are left unsold, around 330 30 units, in a way, all they require is to move 10 units a month, and they'll be able to move everything by the ABSD date. Sorry, just now I said QC. That's incorrect. They will potentially face ABSD if they do not clear the units by 2019. But again, like I said, they've really substantially cleared it, 50% sold within a period of 1.5 years or so. So in a way, they are sitting in a very comfortable position. Okay, yes, correct. Just now I was saying that like they move another 25 units at average selling price of $1,600, and this is much higher than our estimates, around 6.1% higher than our estimates. So we believe that these 25 units, they are moved at 1,644. So we expected some price cuts, or we projected some price cuts for the developments, because in order for them to accelerate these units, the sale of these units. But however, they not only did not cut prices, but more importantly, units have begun to move faster than our expectations, and even better at prices that are better than our estimates. So it's very encouraging to hear it. Nonetheless, if we add these 25 units, the development is 53% sold as of the 27th February of 2017. Okay, still on property development, there are 3 new projects that will be expected to be launched this year. And just now, like I said, both of them when all units in the 3 developments when launched and completely sold, they will add 25 cents or 3.3% to our RNAV estimates. And just a quick update on Clement Canopy. It's a 555 unit condominium project that was launched 2 weekends ago. 2 weekends ago, they launched 250 units in the first phase of launch, and on day 1 they sold 80% of which is around 200 units or so, at an average selling price of $1,350. Again, is higher than our estimates. And if we just use $1,350, when we replace it in our projections, this will potentially add around 0.5 cents to our RNAV. So it's definitely better than our expectations, and we are very encouraged to hear such performance on the ground. And finally, at our RNAV table, we've upgraded our target price. So previously it was 7.05. We put in another 14 cents of each, and we maintain the same discount to our RNAV, which is 20%. And finally, we get a target price of $7.19. And that is all for UOL, and we'll move forward to Hock Lian Seng. So Hock Lian Seng, in 2016, for financial year 2016, revenue was down 32%, and this was because of the absence of revenue from property development. But again, it was offset by higher revenue from civil engineering. What I say again is that in the previous quarter, we pretty much saw the same phenomenon, and that is that there was a missing contribution from property development, but there was higher contribution from civil engineering. And on the gross profit level, the gross profit dropped 22% to $30.3 million, and this was mainly due to a one-time write-back of maintenance cost provision for completed projects. In a way, this is, simply speaking, this is one time, and we are very unlikely to see these moving forward. On a profit before tax level, there was higher contribution from from a joint venture level, and these joint ventures were mainly from the recognition of revenue from the sale of units in the Skywoods residential project. So Skywoods is 100% sold now, TOP in May 2016, meaning to say that there's no more contribution from this development or this development project moving forward. And okay, we talked about the first point already. So 2016's revenue and profit after taxes, came in better than expectations because of the higher margins from the civil engineering segment. Now, just a bit of recap. We talked about this in November last year. They secured this Changi Airport project, which was worth $1.1 billion. It's a joint venture between, it's a 60-40 joint venture between Hock Lian Seng and Sembcorp. And what is to be expected here is that, yes, correct, it will contribute positively starting in 2017. So works have already started in for this project as we check with the management. But what is to take away from here is earnings for this year is unlikely to match 2016 because at the end of the day, most of these contributions previously for Hock Lian Seng was from property development, and there's no more property development contributions until 2018 when they recognize revenue from Shine at Tuas. It's an industrial project, 174 unit industrial project that they are currently developing in the Tuas district. So as we're talking about Shine at Tuas, the company has already launched Shine at Tuas for sale. But at this point of time, sales volume has been rather muted since its launch. The management disclosed that they sold around 2 or 3 units. But then again, what is encouraging to hear also is that we expect sales to accelerate as demand for industrial space. We expect demand for industrial space to improve. So for Hock Lian Seng, we maintain neutral and our target price is 57 cents.
Hi, good morning. Good morning, guys. De Hong here. I'm going to touch on the full year earnings for Hobby Land for FY16. So as the title goes, improving sales volume and interest on the ground to narrow discount to RNAV. This is the main thesis to our upgrading of the target price. From our last report to now, our last target price was at 220. The price has shot up to last done when our report was published to a 224. We have upgraded our target price to 264. Rating stays at accumulate, and I'll go on to touch on why target price is upgraded. So for a summary of the last year's results, there was an improvement in the profits from sale of development properties. Note that this is the first profits from sale of development properties for Hobby Land since 2013. So consistent with other developers in terms of the strategy to move towards more stabilized earnings, a lot of them are moving towards more less lumpy, more stabilized earnings in terms of collecting rents. This is Hobby's strategy as well. They have not had many development projects. They have had 2 in Australia, in Melbourne and Gold Coast, and they've been selling over the past few years, but because the method of recognition for Australian residential properties is on the completed method. So revenue is only recognized once the project is completed, and now that it's completed and majority is sold, profits are coming in and you can see them in the results this year. The problem is that for these development profits, we expect them to taper off in 2017 because these 2 projects are already majority sold. Rental income is largely stable. The bump up is due to the 3 new acquisitions in London in the second half calendar year 15. Slightly offset by a weaker pound versus Sing dollar though. Profits from a share of associates also went up. This is due to the sale of Yanlord Western Gardens, the joint venture with Yanlord. But net profit was down as a result of lower gain in fair value of investment properties. So for Hobby Land, currently the discount to book is 45%. We think that the huge discount to book that investors are placing on the stock is a result of two things. Firstly, there's a huge negativity towards the luxury portfolio that Hobie is holding. The three Sentosa condos, which make up about 16% of our FY17 GAV, continues to be a drag. As you can see, over the last few years, you see a lot of news articles about Sentosa Cove owners selling their properties at a loss. So our model factors in these three condos of Hobie at a PSF of 1,500, which is close to the last done price of all these properties, which we think is a very fair and very conservative estimate. So recently we also see that the activity in high-end property is starting to pick up. You look at the blue bars there, these are the number of transactions in Singapore for properties over a 2,000 PSF, which in the high-end property in the high-end property segment. You see this number dropping since 2010 as a result of various factors, the cooling measures, the tightening of foreigners. So no significant uptick in any year. 2013 up by 2, pretty flat. So 1.6 was the first time you see actually a doubling in the numbers of high-end property transactions, and you can tell from other developers the sales, as long as price is cut a little, you can see all the pent-up demand coming back. You saw that in Cairnhill 9 for Capital Land, you saw that for Twin Peaks as well. So we think that this kind of momentum and activity is likely to continue because firstly, our high-end property segment has corrected a fair bit since the peak. And if you look at the gap between our high-end property prices and regional high-end property prices, like for instance in China, in Hong Kong, in Jakarta, where prices have been going up, and these are countries where our buyers come from predominantly, the Chinese and the Indonesians. So as a result of this widening gap between their property prices and ours, we think that momentum for this Singapore's high-end property is likely to continue. And if this is so, then likely that the price, one of these aspects of Hobie's portfolio, the high-end Sentosa property segment, once the negativity starts to subside, then I think you can see that the discount will start to narrow as well. And then a second part of the portfolio that I think a lot of negativity or uncertainty is focused on is the UK properties that Hobie has. So we've seen that over the years, management has displayed a lot of astute foresight, good foresight, vision. You saw that in 1990, in the late 1990s when they went into London. You saw that in the early 2000s when they went into Sentosa. Now they're stuck with a few Sentosa properties, but I think you look at the number of hits versus the number of misses is skewed towards a lot more hits than the misses. And you look at the way they entered into the Grade A offices in Buona Vista in 2010 and how well the Metropolis is doing now, I think you're looking at a management with very astute foresight. The sale of Rose Court in post-quarter in January this year, that property was acquired in 2013. That was the first year Hobie re-entered into London again after the 1990s. 2013 they bought it, 2017, this year January they sold it. In a period of 4 years they gained 41%, annualized is 9%, even though the GBP dropped post-Brexit, dropped by about 12%, you're still seeing a very healthy rental, healthy gain over the 4-year holding period. And this is not even including the rental yield that the company has been getting since they acquired the property. The rental yield was about 6.5%. So as I've mentioned, the discount currently is about 45% to book. This is a discount whether you look at it from a company point of view over the last 7 years post GFC. This is close to the -1 standard deviation. And if you compare it to the peers as well, peer average is doing a close to 30% discount. It's a bigger discount than peers as well. So based on the reasons we gave above, we expect the discount to book to narrow. Our target price is based on a 30% discount to our RNAV. And with that, we have come to an upgraded target price of $2.64 versus the last done of about 225. Okay, with that, I'll pass on to Jeremy.
Okay, good morning. Okay, last week Centurion has reported the results. The core business operations is in line with our expectation, and that is when we initiated it. Of course, there were some challenges to the business, in the sense that the offshore oil and gas foreign worker population was coming down as that part of that industry is facing a lot of headwinds. And second is the high debt versus the against the value of the properties. So how does the Singapore properties, for example, with short tenure on their land, is able to match up with the high debt? So our proposition for Centurion is that first and foremost, the worker population, although they may come down owing to the offshore and gas weakness, but the moving forward in 2017, the supply and demand dynamics will be favorable for Centurion, as more of the temporary beds, right, the purpose-built workers' dormitory beds will be taken out, owing to this the lease expiring. And second is the regulations for the factory converted dorms. So they have higher stringent rules for that, for those SCDs to be operated. So that could actually also bring the supply of FCDs down in 2017. So and on top of that, there is actually no new supply of purpose-built workers' accommodation beds in 2017. So in that sense, the demand will drop faster than the supply. And the second thing is, when it comes to the debt versus the value of the assets. So we did a cash flow, and we look at the cash flow from there, and it's strong, right? So the net debt against the EBITDA after dividends is about 15 to 16 times multiple, which is still less than the shortest land tenure on the Centurion's balance sheet, which is about 21 years. So it means that their cash flow can still pay back the debt, right, before any of the lease expires. So we are quite proud of, that the fourth quarter results was actually in line with our operating assumptions. And the share price when we initiated was actually 32 cents, and as of Friday's close, it was 39 cents, so it's up 21.8%. So as for the revenue, you can see here the top line actually grew significantly, 23% year on year and 24% quarter on quarter. It was boosted mainly by better occupancy at Woodlands and Papan. So this higher occupancy is also in line with our expectation, right, that the supply coming off faster than demand, and the higher occupancy would also offset some of the weakness in the bed rental. And on top of that, we have acquisition of 4 more UK assets, right? So this has helped support the top line growth. And the expenses were lower because of a write-off of investments in the fourth quarter 2015. And there were fair value losses, specifically from Toguan, because of the regulation that they have exceeded the number of beds permitted, so they had to reduce that. But it was offset by the gains from the student accommodation assets overseas, namely from UK. And from the NCI portion, the NCI registered a huge jump in profits. That's because it's their fair value gains from the Esprit Westlight Papan joint venture. So as for the new 4 new student accommodation properties, they add a total of 519 beds in UK, right, acquired in 3Q16. And the improved occupancy in the dormitories in Westlight Woodlands actually moved from 75% to 90% from 3Q16 to 4Q16. And Esprit Westlight Papan improved from 20% to 75%. So we as in line with the supply with the favorable supply and demand dynamics, we expect the Westlight dormitories in Singapore to operate full capacity by end of 2017. In our assumptions, we continue to assume that Westlight Tuas the land lease will expire in April 2017, and despite that, we feel that based on our extrapolation, they can still maintain the dividends, no problem. So, if in event Westlight Tuas does get renewed and the conditions for the renewal is favorable, there's a potential to re-rate the stock upwards. Okay, so that comes to the end of my presentation. Next will be Q&M Dental Group.
Hi everyone, this is Lin Sin. Just an update on Q&M. So as the title said, back to core business. So they have recently announced that they have been approved to get a quotation or listing on the new China, the new third board in China. So meaning that, sorry, let me rephrase. So that's why we have been, we have seen this 21 million gains of spin-off in their final quarters of P&L last year. So as you can see that their top line actually grew 25%. This is mainly from all higher contribution from all 3 segments. However, their margin, their gross actually did not grow as much because of margin compression. They are higher, especially a higher cost of sales coming from all 3 segments, in particularly from their distribution segment. The margins from their distribution segment was lower due to higher competition in the China side since their acquisition of Shenyang Maotai last year January. Nonetheless, this would be a lesser concern after they are going to spin-off listing of housing. So what we are going to see in this year's bottom line is that we'll see another one-off gain as per this year, as per FY16, where we see 21 million of spin-off spin-off gain, and then 1.1 million spin-off related costs, and we also see 4.1 million impairment, half of it arising from a lower demand from distribution segment, and half of it from the dental clinics in Singapore. So coming back to housing's expected spin-off listing. So it should be it is targeted to be a spin-off by second quarter this year. and this is, well, we expect that it will be spin off at a higher valuation. As you know, the editor was spinned off at was acquired at about 10 times PE, and it was spin off at about double of that valuation. And as for housing, it was acquired at implied PE of about 11 times. And if we take reference from the recent listing on HX Catalyst Board, which housing will be is expected to be listed on, we see there are two companies, one on SOG, which was which was listed at about 12.8 times PR, and another one is HC Surgical Specialist at about 12.5 times PR. Both also will give a higher valuation as compared to 11 times. So in FY17, we should be seeing a one-time listing gain, another also listing costs and professional fees. However, although this would boost its bottom line, but it is unlikely that we'll be seeing a higher dividend payout ratio or special dividend in this year. As you can see that for FY 2016, the payout ratio is actually at a low 31% as compared to its previous years at about 57 and even above. This is because that we continue to expect that Q&M would reinvest most of the gains from spin-off listing into its expansion projects. So what does the two spin-off listings means to Q&M? It would actually impact its profits by 26% lower. So after spin-off listing, both Editor and Housing would become associate instead of its subsidiaries. So previously, Q&M has been receiving about 60% of Housing's profit and 51% of Editor's. Moving forward from this year onwards, we'll be seeing about 44% from Housing and about 38% from Editor. So this would actually indicate about 26% post 26% lower in profits post spin-off. So just to recap, is lower in net profit. It's not that they are losing the whole profit from China's business. So given that the three segments, this one will become its associates, and part of this from the China side will be under its associate as well as the China clinics. So what we'll be seeing for FY18 onwards is that the clinic business will be the sole growth engine, because this distribution segment, we're seeing a lot of headwinds, firstly coming from the weakening of Malaysian ringgit. So most of its machines and equipments are actually coming from Japan, Europe side, Germany side. So Malaysian ringgit is actually weakening against all these currencies, which lifted its cost of sales. Secondly, it's because of the lower demand. Yes, AR Dental supplies in Malaysia is actually one of the top players, but because due to a lower construction of university that provides dental courses, which is also the main demand for AR Dental suppliers as well. So because of all these factors that took into play, we see a lower demand coming from the Malaysia distribution business. So what Q&M management intends to do for these 2 years is to build up its clinic business. So they intend to be more aggressive this year to expand for its clinic networks. So we expect it to be funded via their cash. They have, although that they are currently in a net debt position, and then and considering that about 18 million is going to expire within 1 year. Nonetheless, they are saying that they will be refinancing this debt, and they will be growing their clinics and maintaining quite a strong financial position as well. So just to recap that the investment thesis for a low dentist population ratio in Singapore remains intact. So there's no concern for them that the dental clinic is oversaturated in Singapore. So the key underserved areas that they have identified are west, mainly in the Choa Chu Kang area, Jurong side. As for north areas would be mainly in the Woodlands, Sembawang, Admiralty areas. And they expect to open 3 new clinics in Singapore by first half of the year. And some of the factors that we see that they might dampen patient demand in Singapore is that Singapore government actually tightened claim limits for CHAS and PG subsidies early of this year. So as you know that Q&M is actually a great beneficiary from this government initiative. So by cutting back subsidies, this might actually lower or hamper dampen patient demand. So with this, we downgraded our rating from buy to reduce, and we lowered our target price from the previous 89 cents to 65 cents. So with this, we come to an end to our presentation, and we'll open the floor to questions. Sorry, yes, there's a typo. This one is 0.705, so it's about 71 cents. PATMI meaning profit after tax and minority interest. Just a gentle reminder, please fill up the survey, which is actually in particular for this week's presentation only. So we would like to know more from you that how we can serve you better, and in what aspect that we can improve on. Thank you so much.
Hi, Jeremy speaking here. So there's a question asking input on the Fed rate hike coming up real soon next week. So basically 15 March is when the FOMC will be held again. So according to the probability that's derived from the options and futures market, you can see over here on your screen. This is the Fed meeting, the next one upcoming one on 15 March. The probability of a rate hike coming up is up to 94% right now. So we are pretty certain that if anything goes according to plan, we would see the Fed increasing the interest rate from the current rate of 0.75 to 1%. So moving forward, I think it's almost a done deal that 15 March we'll see the rate hike coming in. The only thing that would hinder them would be this week's non-farm payroll data. So Friday will be a key whereby the non-farm payroll will be released. So if the non-farm payroll comes out according to the market expectation, it's almost a certainty that the Fed will hike its interest rate in this upcoming 15 March FOMC meeting. So the implication of a Fed rate hike, you can see that the market is really sort of pricing in a Fed rate hike. For the past week, dollar has been strengthening based on the expectations of a rate hike. And so moving forward, if they were to materialize this rate hike, there's a high chance that we'll see the dollar continue strengthening within this path, and the dollar will strengthen, and some slight reaction to the equity market. From the US side, probably we will see some minor correction due to the rate hike cycle. And as according to their expectation from the last December's FOMC, they are definitely on track of raising their rate hike, 3 rate hikes in 2017, and March seems very likely right now. And moving forward, they are pretty much in line for meeting the 3 rate hike in 2017. So do keep a lookout for this week's non-farm payroll data on Friday, which will be the last obstacle for the Fed.
Hi, morning guys. Dahong here. Question on interest rate hike continuing from what Jeremy said. So question is, how will the hike affect property counters in the short term? We, like what we said in our sector report for a few weeks ago, we're still advocating a switch from REITs to property developers. So I will touch on REITs first. The problem with REITs is that the strong performance over the past few years has been driven by easy liquidity, low interest rates. So fundamentals were starting to change. You saw like office price indexes, retail rental indexes peaking in 14, 15. Fundamentals were weakening, but because monetary conditions were still easy, so they still performed. But now we are looking at I think you're looking at a condition of switch from low interest rates, low growth to rising interest rates and slightly better growth. So, but the better growth is not translating to on the ground for REITs sectors as a result of an imbalance in the demand and supply. So if you look at interest rates starting to go up but property fundamentals deteriorating, I think that is going to be negative for REITs. And then moving on to property counters, like we said, volume on the ground seems to be improving. Peter can touch on that later a bit more. But so we have touched on in our sector report that developer the prices is a function of two things. It can either be a function of price or a function of volume. So right now we're looking at volume improving, and there is also the additional catalyst of the removing of cooling measures, even though we don't see that happening this year.
Hi everyone, it's Peter here again. So yes, correct, just to add on to what Hong has said, yes, we maintain this view that in the short term, even if there's a interest rate hike, is unlikely to affect the property counters. So what is more important to take note of is the sales volume on the ground. So I recap what I said just now about 2 new development launches, because at this point of time, really is still really about the sales volume on the ground. So just last weekend when they launched Grandia Park Residences, Chip Eng Seng was the developer that's launched a 555 unit development in Tanah Merah. So sorry, it's 720 units. So 720 units within the first weekend, 420 units was taken up at or essentially that represents 60% of the development. So it's definitely very strong take-up rates, and more importantly, it's at the end of the day, it's really still the number of units that are being taken up on the ground.
Okay, we have a question on the view of tech stocks interest hikes, Donald Trump's policy to move back the factory. I assume this is regards to the US stocks. So in regards to tech stocks, technically, I mean, I still view like to take a look at the stocks on stock by stock basis rather than in general as a whole, because certain of them they are I think there's still a value proposition in regards to them, and it's difficult to generalize the tech stocks as because of their different offerings. So I mean, if you're asking things like, for example, Snapchat, which recently just IPO'd, that one I definitely don't think it's a good buy because it's still a loss-making company. Although if you're trying to do a short-term, maybe purely technical play, then that you can possibly try to go in for the market euphoria now. But in general, if you're asking any recommendations as of now, I think do stay tuned to our trading notes. We have a couple that will be coming out within this month, depending on what we look at. We might have a few recommendations for you. On the interest hikes, I think there's enough of history right now in the past couple of years to see how the market has reacted to interest hikes. Overall, in the short term, whenever an interest hike happens, you see the market fall for a little while, and then after that, everything, as long as fundamentally the businesses are not really affected by it, you tend to see the markets tend to recover back to pre-hike kind of areas. So going forward, you probably still see the similar reactions. You have a slight overreaction when it comes to interest hikes, and then after that, people just go about business as usual. There are certain stocks that probably will be affected more than others by interest hikes. I think one of the latest trading notes they released on AFL, you can find that on Poems, will probably be affected. Financial stocks in general who do maybe more investing or buy more bonds, etc. For their investable cash hoards, you probably will be affected by interest rate hikes more. And also Donald Trump's policy of moving back the factory, again, this really affects on a stock-by-stock basis. You have to look at how the businesses will actually, whether it actually makes business sense for them to actually move their factories back to the US, or whether it will continue to make sense for them, because some of them, they are moving their factories back to the US on Donald Trump's insistence, but some are still going to continue exploring shifting their operations outside of the US, and the rest of them are also exploring doing automation. So you might move it back to the US, but then you have robotics or automations doing the actual production. So it's a very general question. I'm sorry, I don't have a very general answer for you, but I have to, you have to pay attention to your individual stocks on a stock-by-stock basis. Sorry. Okay, if you're asking specifically for Apple, then we have released our earnings. Right now, Apple is way above the target price we have initially set. I think Apple is not really affected by as much as by your interest hikes, by your Donald Trump's movement of policy of their production factory. Apple is mainly affected by iPhone sales. So you have to see whether iPhone sales continue to grow, whether they are stalling, whether there is a way to increase their sales for their iPhones, because it still makes up over 80+% of their revenues from purely iPhone sales. So the last earnings report, growth in China was worrying, which is why we ended up lowering our target price. You have to see, I think, in the next probably the next quarter results, whether they are able to arrest this contraction when it comes to China sales, because that is still going to be one of the main key growth markets for Apple if they want to continue growing above their current size. Excuse me. Yeah, so I don't think Apple is going to be as affected by all these interest rate hikes and movement of the policy backloading. Yeah, if anything of Donald Trump's policies that will affect Apple, probably take a look at when and if Donald Trump eventually releases any tax-related issues of whether they can move their cash hoard that's mostly being kept overseas, whether they are able to shift it back to the US without either on a tax holiday or at a greatly reduced tax rate. If that happens, then I will expect to see that Apple's share price will probably go up a lot more. Yeah, so if Apple is not stupid, they're not going to do anything that's going to adversely affect their own productions and stuff. So if a phone is made in US, you say that there's going to be a price hike on iPhones, then Apple's not going to, just because Donald Trump tells them to, move it. You can see when it comes to Apple, they've never really been very pressurized by governments or politics. Even now, they're still fighting, for example, in Ireland for the regards to their taxes in the EU, etc. if Apple moves their factory back to the US, it's not because Donald Trump forces them to, but it's because it makes economic sense to them, business sense to them. So I expect that they are smart enough to be able to do the calculations, etc., to see that actually in the long run it makes sense for them to move their factory back and produce the phone in the US itself. Probably, like I said, maybe they will invest in automation to cut down on labor costs in the production of the price hikes. Anyway, based on the demographics of the main iPhone users, price hikes tend to not really be the key factor in affecting iPhone sales for the US itself. When it comes to other markets, for example, China, that might possibly affect them a little bit more, but the price of the iPhone itself has historically not really been the key issue when it comes to iPhone users buying iPhones. Yes, the iPhones tend to have a lot of stickability regardless of I think the price that they're charging. Although it might affect them more in emerging markets, but they have the cheaper iPhone, the iPhone 5, the cheaper iPhone that they're producing to target emerging markets. So if that's their strategy, then they'll probably price that iPhone better for emerging markets wise. Yeah, hope that answers your question. Okay, if there's no further questions, thank you all for attending, and we'll catch you guys on the next week's webinar. Please remember to do the survey for us so we can have better feedback as to how we can help you guys better. And yeah, we'll see you guys next week. Thank you.